Good morning, good afternoon, or simply good day, depending where you're joining us from. Thank you for joining us for the third webinar in the BAFT Future Leaders Class of 2026 series, the 11th class of the program. I'm Daniel Pino, and I oversee the BAFT Future Leaders program. This webinar series was created to give project teams the opportunity to take a deeper look at their white papers that were presented at the global annual meeting earlier in May. And we're pleased by the strong interest in the series that has generated so far. A couple webinar reminders. Everyone is muted to reduce any noise or distraction during the presentation. Video is also turned off for everyone except the speakers. And the webinar is being recorded and it will be posted later after the session. For asking questions, please use the Q&A button to submit your questions in writing. You can also raise your hand and we will unmute you to ask a question verbally. Today's session topic is leveraging emerging technologies for the advancement of trade financing, such as artificial intelligence, blockchain, and tokenization, and how these can be implemented to improve cost efficiency, enhance risk management, and drive new revenue opportunities. Each year, BAFT councils submit potential topics, and the board selects those that are the future leaders develop into white papers. The team's white papers available free of charge to BAFT members in the online store and under member twos and future leader white papers. You should have received a link to download with the registration confirmation, but I'll also post the link on the chat. Before we begin, I would also like to note that the applications for the 12th class of the Future Leader program will open in early August. Candidates must be nominated by their BAFT member organization, and the application link will be sent to each organization's primary contact. If you have any questions about the program, please feel free to reach out to me. Without further ado, I'll transfer over to the team.
Thank you very much, Daniel, and I'll go right into it. So we will begin with a slight introduction before we go in, an introduction to what we've put together in the white paper. Trade finance sits at the heart of global commerce, supporting over $30 trillion in global trade annually. Yet its operating model is still largely paper-based, is fragmented, and is manual. Now, the white paper is not about futuristic technology. It is about practical execution. How emerging technologies like AI, distributed ledger technology, and tokenization can be applied today to modernize trade finance in a way that is commercially viable, is risk-aligned, and scalable. And the core message of our work is simple. Trade finance no longer has a technology problem. It has an execution and coordination problem. The tools already exist. The real question is, how do we deploy them properly? Now, just to go around in this reality, I'd like to ask a quick rhetorical question. How many of you have seen a trade transaction delayed by documents rather than risk? Exactly. And that's where we're going to start. So what slows down trade finance today? It is not one issue. It is the combination of paper, of fragmented processes, and repeat controls. Let's walk through that in a bit more tangible way. Take a simple guarantee issuance, something we all know well. You've got an applicant, an issuing bank, often an intermediary, a beneficiary bank, and finally the beneficiary. Now, in that chain, each party is holding its own version of the same documents. There is no shared record. there is no single source of truth. So every step introduces delay, reconciliation effort, and operational risk. And then on top of that, compliance, AML checks, sanction screening, document verification. Those checks are repeated at every single step. Why? Because we don't have a trusted, reusable data layer. And the consequences of this is not just operational, they are structural. In the white paper, we highlight a global trade finance gap that is exceeding $2 trillion. And it disproportionately affects SMEs and the emerging markets. So this isn't just inefficiency, it is limiting access to finance. So the opportunity here is not just digitization for its own sake. It is about something more fundamental, moving from a document model to a data-driven model, where information is verified once and reused safely across the chain. And just to make this practical with another rhetorical question, if we could verify once and share across the entire transaction chain, where would you feel the biggest impact? Is it on turnaround time, fewer discrepancies, or stronger compliance confidence? Let me now take this to make this very concrete with a real end-to-end example. So on the end-to-end use case, we've used a simple, familiar example, a cross-border guarantee for a software contract where you have an applicant, an issuing bank, an intermediary, beneficiary bank, and the beneficiary. So step one, AI. Let's start here at the document layer. Trade finance generates huge volumes of documentation, commercial, transport documents, contracts. Today, much of it is still reviewed manually. AI changes that fundamentally. It can extract the key fields, compare draft versus final, and flag inconsistencies before release, which means fewer discrepancies, faster processing, and lower operational risk. Now, the second problem is coordination. Today, each party maintains its own records, and reconciliation happens after the fact. Distributed ledger technology flips that. Instead of multiple versions, we have one shared tamper-resistant record. All parties see the same version at the same time. The outcome? Fewer reconciliation breaks, reduced friction, stronger auditability. Now, once documents are fully digitized, we unlock the next layer, tokenization. This is where trade moves from processing to reimagining value. Payment obligations become digital assets. Assets become transferable, and settlement becomes programmable. So this is not just about speed, it's about liquidity, distribution, and new funding models. And importantly, it is not theoretical. This paper highlights a transaction executed by one institution, processing time reduced from 5 to 10 days to under 24 hours, and in some cases, less than 2 hours end to end. And at the same time, controls improved, transparency increased, and the auditability strengthened. So the technology clearly works, which brings us to the practical question, where should banks start? The answer from our research is very pragmatic. You pick a corridor, pick the workflow, prove the model, then scale. Now, this is not just a sequence, it reflects complexity and dependency. AI is a fast natural starting point. Why? It sits within the existing processes. It delivers quick ROI or return on investment. It improves controls. And importantly, it does not require any legal changes. So this is where we see immediate traction. DLT or distributor ledger technology is more complex because it requires coordination. So instead of scaling globally, we go corridor by corridor because corridors concentrate volume, relationships, and repeat transactions. And this paper highlights major corridors, including the Africa Continental Free Trade Area, as natural scaling laboratories. Tokenization comes last, not because it is less important, but because it depends on digitization, governance, and ecosystem readiness. Tokenization is a strategic capability, not a starting point. So the key insight here is scale is not limited by technology. It is limited by ecosystem coordination. And that leads directly to the real barriers. Over to you, Maria.
Thank you, Teresa. Yeah, and one of the biggest lessons from our research is that technology is actually not the biggest challenge anymore. When we start this project, we thought most of our discussion will focus on AI, blockchain, and tokenization. But after reviewing real use cases, speaking with industry professionals, and analyzing what is happening across different markets, we realized something very important. The technology already exists. In many cases, it is already working. So the real challenge is everything around the technology. For example, legal and regulatory fragmentation continues to be a major barrier. Imagine a digital bill of lading or a digital trade document. Maybe a bank in one country may fully recognize that document electronically, while another country may still require a paper version of that document. Even if the technology works perfectly, the transaction can still slow down because regulations are not aligned. Another challenge is interoperability. Today, there are many digital platforms in trade finance, and we know that. But if those platforms cannot communicate with each other, we simply move from paper silos to digital silos. And that limits the value that technology can create. We also found that many banks still operate with legacy systems and highly manual processes. And we thought, and I think many of us can relate that. Implementing a new technology is not only a technology project. It is also a people project, a process project, and a change management project. And maybe one of the most underestimated challenge is incentives. Sometimes one participant pays for technology, but the benefits are shared by everyone. When incentives are not aligned, adoption becomes much slower. So what are institutions doing successfully? And one common theme is starting small. Instead of trying to digitize every trade transaction, they focus on a specific corridor or workflow first. And a great example is the Trade and Development Bank in Africa. They use blockchain in a live trade finance transaction, worth approximately $22 million. And what is interesting is not the technology itself. What is interesting is the result. The transactions went from taking several days to less than 24 hours. And that demonstrates that technology can create a real operational improvement when applied to the right use case. Okay. So another example is the Europe-India Economic Corridor, also known as IMEC. This corridor is supported by major economies, including India, United States, the European Union, and Saudi Arabia. Why is this important? Because large trade corridors create the perfect environment to test and scale digital trade solutions. They have transactions volumes, recurring trade flows, and strong incentive for participants to collaborate. That makes implementations much easier than trying to transform the entire market at once. And that brings us to one of the key conclusions from our project. The next one, okay. What is the real challenge? Technology or execution? And the answer is very simple. Technology works, it's already working. The real challenge is execution. AI works, blockchain works, tokenization works. We already have examples proving it. Take AI as an example. Banks are already using AI to review trade documents, identify exceptions, and automate manual tasks. Instead of spending hours reviewing documentations, teams can focus on exceptions and decision making. That means faster processing, lower operating costs, and better client experiences. Or take tokenization. One example is Standard Chartered participates in a Singapore Project Guardian and successfully tokenized approximately $500 million in trade finance assets. The technology worked. The challenge was not technical. The challenge was regulations, governance, and market adoption. So, what should banks do? First, digital trade finance is no longer optional. It's becoming a strategic priority. Institutions that want to remain relevant in an increasingly digital trade ecosystem need to start preparing now. Second, start small. Pick one corridor, pick one workflow, measure results, learn from that experience, and then you can scale. Third, focus on governance as much as technology. Without common standards, aligned incentives, and regulatory support, scaling becomes very difficult. Technology alone cannot solve coordination challenge. And finally, the opportunity is significant. Digital trade solutions can reduce processing time by up to 8% and lower operating costs by 30 to 50%. At the same time, they can help address the global trade finance gap, which still exceeds $2 trillion globally. So in the end, this is not really a technology problem. It is an execution challenge. And the institutions that move first, collaborate ethically, and focus on practical implementation will be the ones that capture the greatest value from the next generation of trade finance. So, as we said, the technology is ready. The opportunity is clear. Now, the challenge is turning innovation into execution. Thank you very much.
Yes.
You
Thank
said the
you.
questions?
Yeah.
There's a question about which technology the team think the corporates will drive banks to implement first. And the team wants to take that.
Thank you, Daniel. I believe that the first technology, actually, they're all overlapping. So it's implementing the 3 stages of technological tools that we have discussed is critical here, because I believe they complement one another. They do not compete with one another, right? But I believe what is currently being more utilized is the AI, right? Because AI is involved in compliance, KYC screening, in monitoring transactions, in maybe when you're having a performance guarantee, for example, it filters out the document, flags exceptions, and tells you what is wrong with it early on, so that in the next stages you don't really spend that much time reviewing the transaction and doing duplicate actions on it. So AI eliminates this unnecessary actions when the document hops from one stage to another, from one bank to another, from the applicant to the applicant's bank, to the intermediary bank, and all the way to the final beneficiary. It just has this sort of capability that can capture all the data in one place and eliminate any duplicate actions or requirements on that document. So I hope that answers your question.
There's another question on, you list one of the key barriers as interoperability gaps between platforms. How the industry can overcome this?
I believe the industry can overcome. This is a very good question, actually, because implementation is the key challenge here, and I believe digital literacy is the ultimate barrier when we're talking about the challenges. Because maybe in many countries or places, there is still very limited knowledge about the tools and the data they can actually use. And I believe the other challenge is maybe fraud and risk. When you digitize your documents and your data, it's all stored in one place, and on a DLT, for instance, and some breach happens to this DLT, then the organization is in trouble. But I believe with the right maybe monitoring and giving the governance role into these tools, strict governance should be applied, and also strict monitoring and updates on these platforms that would later prevent some unfortunate incidents to happen.
If you're looking, okay, there's another question. And by using blockchain, tokenization, etc., will the ops risk RWA charge be reduced or eliminated?
By using blockchain tokenization, I think it should be eliminated. Yeah, definitely. Because when we're talking about the risks here, it's no, definitely not eliminated, because there still will be risk, because these systems requires updates and, of course, operational costs all along the way that would help it develop over time. Because you see, technology, this is the same thing with technology, it's always developing. You need to keep pace with the current environmental changes, so you'd still have to spend on updating it, on developing it. And of course, the risk still exists, because the more the updates are here, the more that people will try to maybe penetrate those laws of the digital tools. So this is currently the issue with the technology that we are talking about. So yeah, that's it.
Just to add to that, I think one of the other issues that we anticipate to face will be around cyber criminality, because I think any new sort of emerging technology will have to be associated with sort of some cyber criminality risk. And I would segue to the next questions, where on whether if these technologies really gain scale, would it drive the implementation costs down for smaller banks, or particularly for smaller markets, or will it just amplify the TJ gap? This is something that we have elaborated in the paper quite well in section 2. We are of the view that implementation will really vary across markets, especially for smaller markets. At the moment, it's one of the biggest challenges because implementation is costly, and even if it is widely adopted, it's sort of the biggest question would be, who is trying to bear the cost? Who is going to bear the cost of implementation? For larger banks, of course, that may take time, but even for the smaller counterparties, the investment would be quite heavy, depending on the trade flows that would be generated. So our bottom line is that it will take time, but it doesn't prevent all the parties from starting. And this is what we recommend in the paper, to say, we can start small. We can pick one corridor, we can pick one business issue. Each of all those parties involved in trade transaction can pick one of those issues within their own organization, trying to automate them. And that's what the purpose of the paper is really about, to just try and give a range of solutions that can be implemented, and so that it can serve as a toolkit.
Another question talks about, compliments the team on a well-done job. Given the issue on adoption to date lies in execution, what needs to be triggered to speed this adoption up?
I think this is a very good question. I believe the slides even didn't has partially covered it, but not into details. But I think the what speeds this up is the legal certainty. So if you're standing on a solid jurisdiction here, and the laws and regulations supports these tools that you have or you want to develop in an institution, this speeds up the process. So you wouldn't have to go through the hurdles of familiarizing the institutions of one's country to the new technologies that you currently have and you want to embed into the financial institutions. So financial institutions are very, it's a very sensitive sector. So if you want to develop something new in it, you need to develop the legal framework, and the legal framework would then allow you to monitor this and set the rules and maybe the right governance that protects you later on during the implementation of the several tools we've discussed, including the AI and blockchain This will facilitate all the implementation, all the funds also necessary to implement these in central banks, and it then will have a waterfall effect into the other banks as well. Yeah. I hope that answers the question. Maybe I can take another question. So it says, what percentage of banks are utilizing DLT and AI for LC examinations? And I think many banks are doing so. And while I'm not really aware of the percentage that is being applied, but I'm very well aware that most of the banks currently are doing so, especially in Europe and the US. So it's about time now, because trade and borderless payments and transactioning is very critical, and it's the new thing now. It's not the trend. It's currently happening, and what we need to do now is that we need to utilize it, because the less banks are utilizing DLT and AI for LC examination and settlements, the lesser and lesser they become relevant in today's market. Yeah.
I'll take the question on whether there is any risk with digital trade document and AI document. We are of the view that definitely these technologies help, especially with the volume. We talked a lot about the trade being very paper based at the moment, so it will help a lot in document processing. But the biggest challenge would be in terms of how the AI, the tools are being trained to extract information from those documents. At the moment, most banks really rely on the reviews and sometimes even peer-reviewed documents for actually confirming trades. So interpretation can be an issue, but also legal enforceability as well. Not many jurisdictions. A lot of us within this group are working in emerging markets, and most of those jurisdictions don't necessarily recognize that sort of from a legal perspective, the level of accountability that is given to an AI tool compared to sort of human oversight. So our bottom line is to say these tools definitely will help, but oversight and the cross-checking from the experts, trade finance with experts, will still be needed. And that would be the biggest risk if oversight is not there. Definitely, banks are facing risks, and also regulation has to follow.
Just let me chip on a little bit more on Hanesia's comments. And in terms of data risks, if we can consider that the bank is not existing, the bank, the risk calculation system is not making the risk as zero. The basic of the terms of the risk control is a target to manage the risks, which is the calculated risks, and then we bear the risk which is calculated. So, and as of now, we are bearing the operational risks made by human. So, which means that leads to the human errors. And then also, if we embedded the AI tools, that also it leads to the AI risks. But we can control that, and we can learn it through with that, and we believe that can enhance our profitability returns itself, and then that leads to our banking system development in itself.
Do you want to take another question there? On they brought a great example on the use of tokenization, but when or how soon, maybe already addressed, that will be widely adopted, particularly in tokenization. Is that an expectation?
Yes. So I think that also resonates with another question that we have that says previous DLT initiatives for trade finance have failed as banks haven't been able to scale. So what is now different? But so the greater challenge here I see that closed platforms chasing network, maybe it has an effect, right? Because if you're developing something new, you need to first test it out, and then failures will arise. But then you need to also develop on these things. So, for instance, we have AI. AI has been into development for years now, and it's almost they started testing on AIs since the early 2000s. So now it's being a thing. So now it has reached a level of maturity that can be used in institutions and banks alike. So I believe the same thing happens with the DLT. So if you want to see measurable performance, we don't need to give up on it on an early stage. We need to develop and continue on developing this tool until we reach the exact desired level of maturity for this tool, so we can see a noticeable difference in the market.
And I'd love to cover the last question. Is there a lack of competition in trade finance? That means a lack of incentives to invest. I thought it's very interesting question, because I thought that's totally opposite way. Because in Korea, specific in Asian market, and APAC markets, so we are very highly competitive in trade finance, and also the loan market as well, and FX, of course. So it means, which means that leads to the pricing competition itself, and then but by developing AI and actively embedded AI tools, and that makes ease our operational burden, that will help enhance the profitability and effectiveness in operational process, and then that makes more bring some more capability to our handle the more operational things. For example, like trade documents reviewing and the screening process and exceptional probable process sort. So we think that it is also as of time at this time being. I think that will be the huge incentives to invest itself. And then as time goes by, the AI is not the inevitable waves that we can compete and we can fight. So we think that's going to be the huge incentives, because of the fear of the missing out, for not embedding the AI tools, they're going to be the huge incentives our banking market as well.
And I guess just to add on to Celine's answer, I think we also need to consider non-bank entrants into the market, so fintechs, who also add a level of competition to us. So I agree with the sentiment that actually there is more competition rather than there's a lot less competition. And with these non-bank entrants, we're looking at organizations like Taulia, for example. We're seeing that their adaptation of these emerging technologies already mean that large corporates in particular, are more attracted to them. They're seeing, okay, this is what can be done in the market. Let's take a look. Let's explore. Let's see what they can do that a lot of financial institutions can't at the moment. So I think this also brings a lot of competition because these are mutual clients that obviously one bank would prefer to have a monopoly over, or one entity would prefer to have a monopoly over. So I think the reason for slow adoption or slow investment / no investment wouldn't be to do with competition, but more likely the fact that, we're going from a system that's highly complex because of, transactions that require over 100 pages of manual documents, for example, and moving that to something that's essentially meant to be quicker, meant to be more efficient, can actually be quite daunting to the human mind. And we need to take that into consideration as well, that even though technology, as we speak about it, it sounds great, to the human mind, it can be quite daunting. And then when you put everything together with regards to all the different end-to-end process of deal opportunity to execution, there's actually a lot to consider before we can reach a point where the use of technology is actually beneficial.
You want to take one of the last questions before we close the webinar? There's one on letters of credit. Given the variety of paper documents issued by different entities that can be required in a letter of credit, how do all those entities agree on a common standard for issuing electronic documents? I think that's still under development. You want to take that question?
I'll take that. I think at the list of very interesting question and very pertinent at the moment as we are looking at what the ICC is trying to do with this electronic documents. Definitely, there will be challenges because we look at the market again. The markets are quite different. If we look at the market, for instance, it's still a challenge to implement proper uniform electronic documentation or even submission of copies of electronic documents. That's a lot of banks. There was a question earlier about why DLT Ledger has sort of slowed down in the recent years. This is part of what the DLT Ledger technology was trying to solve. So I think the quick win would be to look at sort of the regional markets or the regional trade corridors whereby standards could be implemented within those corridors. Such as, so if we look, for example, in a lot of East African markets where they have those bulk procurement systems for dual import, where they use letters of credit, local sort of the procurement agency for the country sort of sets out those rules for document presentation. So definitely, I would say the quick win would be to look at the regional association or the regional trade corridors and see how banks can collaborate.
Wow.
I think with that, we address all the questions. Thank everyone for participating. The next webinar will be next Tuesday at the same time. Please register and let your colleagues know and download their papers. Thank you very much, everyone.